Has the market bottomed, and should you be putting more money into the market right now? Should you be investing more? Should you be burning up some of that cash position so you make sure you get into the market? Well, obviously, the answer for the long term to that is yes. But today we're going to be going through the charts and we're going to be looking at some technical analysis to figure out what are the key levels we need to be looking at to get more confirmation if this is a bottom or we have lower to fall. So without further ado, let's get straight into it. Welcome in, friends. On the chart, you can see this Williams percentage range and all these arrows and bottom verbiage and everything, right? I posted this about a week or two ago. And when I posted this, my thought process was every single time since about 2019, when we've come down to the Williams percentage range, green barrier, we've had very extended selling. And we typically, at that time on the weekly chart, have gotten a bottom or a strong bounce, okay? So these three times, 2019, 2019, and 2020, we saw bottoms. Here in 2022, it was the beginning of the bear market. So we saw a downtrend and then a 4.5% bounce and then a continuation of downtrend and then a bottom off the next time we hit that negative 100 and small bounces here, but we weren't actually at the negative 100 here. 6% bounce. We did fall lower until we did bottom. And then here we bottomed and then here we bottomed. So pretty much every time outside of a bear market, we've bottomed within a few weeks of us reaching this green barrier. I know that's absolutely crazy. And I know it sounds like gibberish to anybody that doesn't believe in technical analysis that's watching this video. But the thing that you need to know about technical analysis is it's not a predictive, witch, okay? Technical analysis is more about probabilities. If you believe in math, if you believe that and if you believe in probabilities, then you can get behind technical analysis because you can base it off things that happened in the past. And you're basing everything off of if X happens, then Y happens. If Y happens, then Z happens. It's all about the probabilities, right? So for instance, with the Williams percentage range here, every time we've bounced here, what does that mean? We have recency bias, yes. But if we've bounced every single time, do you think it's and so say this is like you're at the roulette table and every time we've bounced here, this is essentially black showing up or hitting on the roulette table. If this hit every single time, are you betting black or red here? Are you going to go with the trend or against the trend? You're going to bet black at the roulette table because you're going to stay with the hot hand. You're going to stay with the probabilities. And that's what technical analysis is here, guys. So since this, we actually did get a 4.5% bounce so far on the S&P 500. Now, does that mean we've bottomed? No, it does not mean we've bottomed. This could be a bear market, beginning of a bear market, or this could be an outlier where just because we bounced here and we run up here, we could have another leg lower and it could still be a correction, right? This could be the first time that it's a correction and not a bear market or not a bottom overall. So that's one thing I wanted to show you, kind of recall this. We could keep running up. Obviously, here on the Williams percentage range, it's mainly a momentum indicator. So we could keep running up here, but some other things I'm going to show you in this video on looking under the hood and where we should actually be looking. Second thing I want to point out. I've been talking about the quorum a lot lately on X and in my collective. And basically the quorum is telling us, right? Or it's foreshadowing and showing us when things are getting hairy. And just like back in 2025, things got very hairy and it kind of followed the same path that it did recently. And we had this consolidation, this downward trend, and then we had a breakout, a pullback, and then the big move on Tariff-Geddon, where we saw a huge loss overall in the markets and a big flush. Now we're seeing the same thing here. Downtrend, we broke out, we ran up. Now we're pulling back. This is very key. Last time we didn't cross below the 6 EMA on the quorum. This time we did cross, right? So when we crossed here in 2025, that was bottom. When we crossed here in 2026, it could be bottom. But we need to put everything together and say, okay, Just because one of these things happened, just because it happened before, it doesn't mean it's going to happen again. We want to look at every angle and all the probabilities. This is the temperature. This is one of my indicators down here. This was the one kind of warning me whenever I was telling people that, hey, I think we could be getting a correction or pullback here soon. We crossed above the zero line and have stayed above the zero line this entire time back in 2025. And we've done the same thing since October, coming down a bit, but then also coming up. And obviously, overall, the markets have continued down. And with this, it's kind of like inverse the markets. As it goes up, markets go down. As it goes down, markets go up. So that's the quorum. I'm looking at that. I'm really wondering if we are going to bounce here soon on the quorum, and then obviously bounce and then take out this high. If we do that, then yes, we will see a further correction and or bear market. If we make a lower high and then continue down, then this correction is more likely to be over and concluded for now. Okay, so we talked about those two things. Now let's jump on over to a weekly chart, right? So a weekly chart, the overall trend is bearish still, okay? We have not flipped back. Let me get rid of some of this stuff. We have not flipped back to bullish. When we flip back to bullish, it looks like this. This is 2025, consolidation, a bear trigger. My indicators, the matrix and the flow start telling us, hey, things aren't looking good. We crossed down, never crossed back up and continued down. We made a bearish cross here on the high five trend. Really, this is how I trade. This is how I look at overall markets. The trend is the red and green line. Green is bullish, red is bearish, and then a bearish cross is bearish and a bullish cross is bullish, okay? And then you have the matrix here. The matrix ebbs and flows, goes up and down, and it's the overall trend in the momentum. And then you have the flow, which is basically volume momentum, okay? So down here is bearish, up here is bullish, so on and so forth. I teach all this in the Trading Collective. If you want access to that, I'll leave the link down in the bio below. We get access to all these indicators and we teach all of these, how to look at overall markets, how to look at indexes, and then how to look at individual stocks and find stocks to trade. Anyways, 2025, we consolidated. Then we had a bear trigger. Things started not looking good. Then we had a bearish cross, which is like double, 2x bearish. And that's when we really fell. And then we sat there and said, okay, bottom could be in here. We don't know. Let's see what happens. And then we got a bullish cross and a bull trigger. And then we said, okay, we're good to go. Coast is clear. We're up, and away. Now, as a long-term investor, I am not sitting here timing the markets. I'm not sitting here saying, yeah, you should wait exactly until here to buy. I wait till here to buy half. The other half is whenever I buy down in here, when I know that we are extended down in the sweet spot and we are oversold. So investing purposes, because I don't want people to come at me being like, time in the market beats timing the market. I understand that, but I'm a trader and I'm an investor. And I, even as an investor, want to know market cycles. Market cycles are extremely important because I don't want to hold and have zero cash through a 2022 bear market. Do you? No, I didn't think so. So nobody wants to not have cash to take advantage of all these deals down in here, like Palantir at $5, at HIMS at $2, NVIDIA at like, I don't even know what NVIDIA was at that time, Meta at $88, right? Nobody wants to not, people want to be able to take advantage of those deals, okay? So market cycles do matter. Right now, the weekly is telling me that we are still bearish until we until we at least flip green on the trend, until we at least cross bullish, until we at least start climbing up here on the histogram, right? Something on the weekly. Daily's great, but I want to start seeing things stack up on the weekly and show me, hey, we're more and more bullish. If they don't, you can clearly see what happened in 2025. We stayed below the red high five trend. We are staying below the red high five trend, and we've already made a bearish cross. We've already had a bear trigger, so we're overall bearish. Now we bounce right here off this key support. The next support is this high from 2025 before Tariff-geddon. And then after that, you have like 520 support. And then I would say you have like support in here around like 487 to 500. Okay. So I'm looking right here overall. What are we seeing? Let me get some clarification. And then if we look under the hood at the daily, we can see that we are starting to get some bullish signs. QQQ has printed, QQQ has printed a bull trigger. QQQ has flipped up and out of the sweet spot on the matrix, and we're climbing up and out on the flow. But the daily cannot be trusted like a weekly or monthly. The lower time frames you go, the less likely the probabilities. Because think of it like this. One candle is one day. Would you rather go off of four candles that are 1 week each, so a whole month of momentum, or 4 candles that are 1 day each, and that's only basically almost a week if it was last week and the markets were closed Friday? I rather go with the higher time frame that is telling me the larger momentum. Now, the smaller time frames will be quicker to tell you when the momentum is flipping, but they're less accurate. So since this bear trigger way back here in November, right, look how many times you would have been faked out, right? Fake out, fake out, fake out. And you can overall see that we are in a downtrend here. We're in a sloping downtrend, lower highs, lower lows, so on and so forth. So we're looking bullish here. We bounced here, but this doesn't mean anything. The first step in for this to be a bottom, we need to reclaim this 20 smooth moving average SMA and 200 SMA. This is basically over the last 200 days, this is the average, okay? And then over the last 20 days, that's the average. And it's smoothed out. So if we can break over this, retest it and bounce, then I would be very confident that this is more likely a bottom, and you would also be breaking out of this downtrend. So we're in this downtrend, and then, oh, wait, breakout, retest, now we're going higher. Then I would be more likely to be sold by this. And if we did that and started climbing higher on the daily, well, obviously, as you know, we would reclaim the 9 EMA on the weekly and continue to bounce higher and start reclaiming the 9 EMA, the smoothing average, and then going up and away, and then even reclaiming the 20 SMA up here on the weekly, right? And then, yeah, there's a 50 as well. So 20 and 50 would need to be reclaimed on the weekly. And just overall flipping all this and saying, okay, we're good. Make another bullish cross, have a bull trigger, and then we can sit there and say, okay, we are now in the climate of clear skies, meaning every time we've gotten this, we've had a nice bull run, a very nice bull run. And it's obviously a lot easier to make money when you have this consistent up bull run and you're holding the 9 EMA on the way up, and you can sit there, then look into the indexes, and then you can look into individual stocks, find the best setups, and the setups will work better. They'll work more. If you're in chop, setups work less. There's more fake outs. If you're in a downtrend in the overall markets, that means the overall ETFs, more ETFs than not, are in a downtrend. That means if you're trying to find bullish setups, so you're trying to find setups to the upside, when the overall markets are coming down on your head, when the overall ETFs are coming down your head, ETFs being, all the individual ETFs that hold tons and tons of stocks, right? You're down here and you have one stock that you are trying to say, this one's going to be bullish. This one's great. Okay. And especially if you don't have a theme, something going in your favor, like news or a theme or something that's really working, it's very hard. You have overall markets pushing down against you. You have overall ETFs pushing down against you. Overall sectors and ETFs pushing down against you, saying, no. We're bearish, bud. We're bearish. You ain't going bullish. And so when you have that, it's easier to obviously short, but even then it's tough whenever you're shorting. And then if you're late to short, you get this big snapback and then you're in big trouble, okay? Either way, with trading, it is a lot easier when you have a profound trend. When you have a really good trend to the upside or really good trend to the downside, it is a lot easier to trade in the same direction as the overall trend. When you get chop, trading both bullish and bearish setups based on, the ETFs and the sectors and whether they're bullish or bearish. So my final thoughts on the markets overall as well in the war, I don't know. Nobody knows. Nobody knows if it's going to end next week. The T-Man is literally just going back and forth. Who knows what his game plan is, what their overall game plan is, if there is a game plan, if there isn't a game plan. We don't know. Our job in the market isn't to sit there and try to be geopolitical head figures, right? Look at CNBC. They're always wrong anyways. Tom Lee has been wrong a lot, okay? Not to crap on Tom Lee, but dude saying like all-time highs for SP 500 with like 1 week left in March. It's crazy, guys. It's crazy. Our job as investors or traders is to find A+ setups. Whether it's an A+ setups with fundamentals and technicals, whether you don't believe in technicals and it's just an A+ setup with fundamentals and you want to keep dollar cost averaging like some people did from 20 on Palantir all the way down to 5 and then from 5 to 10 to 15 to 20 to 25 to 50 to 100 and you keep DCAing. That's fine too. That's fine too. Everybody has a different way of doing things. But our job in the market isn't to predict exactly what's going to happen. It's to react to what the market is telling us on the technicals and what the market and what the company, right, when we get into fundamentals and investing, what the company is telling us. If a stock price is going down, that's price action, yet the fundamentals are going up and up and up and up and up to the right, who's wrong? Am I wrong? Well, I could be wrong. Maybe Wall Street's seeing something that I don't see, but that's usually not the case. Sometimes it's just the overall macro environment. When markets are weak, stocks are weak. When markets are strong, stocks are strong. Sometimes whether the fundamentals are good or not. So just understanding that will help you in your overall investing journey, in your overall trading journey, and understanding these cycles of the markets. And not just sitting there saying, man, I'm really a genius right here. I'm so good at picking stocks, blah, blah, blah. Well, we went on this historic bull run since the bottom of April into October. And then you were probably feeling like, man, I suck at trading. I'm terrible at investing because you're literally losing money or you're chopping sideways or your stocks are going down. During this chop, stocks like Robinhood and SoFi and FinTech and IGV, which is SaaS companies, they all went down, down, down. Even Zeta. And Zeta's fundamentals, OpenAI partnership, better fundamentals, better numbers, free cash flow, they crush earnings. But guess what? They're going down because the overall macro for SaaS companies and finance companies is down, even though the market's sideways. Where photonic companies are up and away, and defense, drones, and space companies were up and away during this time. So you see how that works out. But during this time, it was like, what isn't going up? What isn't going up? There was a couple like PayPal and Nike. They were still going up some. But you get what I'm saying. Market cycles matter. This is what we teach in the High Five Collective. This is what we teach there. And then on the investing side, we also talk about, my kid is freaking out. Oh my goodness. We also talk about in valuesnapshot.io. That'll be linked down below as well. We also talk about, just giving you the tools that you need to succeed and find these undervalued companies fundamental wise. And then we also talk about some of the technicals and making it really easy for like automated technicals and stuff. But I hope you guys enjoyed this video. To sum it all up, basically, we need to be looking at these daily levels and see if we can break above here. Because if we can't break above here, guys, and we reject, then the likelihood of us going lower is more likely. But if we do break above, retest, and continue higher, then I do believe we are getting closer and closer to an overall bottom. Appreciate you guys. Smash that like button if you enjoyed this type of content. I'll keep making it if you guys want to see it. And I'll catch you guys in the next one. Take it easy.